back with First Trade, and as promised, let's continue interacting with managements across India Inc. We have the management of Anupam Rasayan, the CFO, Mr. Vishal Thakkar, the Deputy CFO, pardon me. He's joining us on the show. And Mr. Thakkar, let's deep dive a little bit into your numbers. If I take a look at your second quarter earnings, revenue, very solid uptick on a year-on-year basis, about 2.5 times. Your EBITDA is up 68%. That is also very healthy at 84% uptick. But margins is somewhere where we've seen extreme pressure at 18.6% compared to 27.6%. If you could help us understand what's causing the pressure on the margins, and by when do you expect to rebound to your historical 25% thereabout levels?
Hey, good morning, and wish you happy Diwali. I hope you had a good vacation, if you had one. Thank you for getting us. One thing, let me say that this quarter has been really great, and also the first half. If you really look at it, in this half, we have really delivered a good numbers. As you said, our revenues have grown practically. Our first half revenue is equal to our last year's total full year revenue. Also, if you look at from an operating cash flow point of view, we have generated about 350 odd crores of cash from the operations. So overall, a good half for us and good quarter as well. In the first quarter, in the second quarter, if you see, there has been a one-time sale of around about 150 odd crores, and which is what is the reason that you are seeing that there is a compression in the margin, because that's one time when we have liquidated inventory at a fairly lesser margin than what we would have ideally done. So if you knock that off, we will be at around 20 to 24% EBITDA margin, and we believe that as we go forward, we should be coming back to the EBITDA margins of 24-26%, which we have been guiding. Also, you have to also appreciate that we have recently launched multiple products in pharma and polymer, which takes a few quarters to really get to the level of volumes, economies of scale, and margins that we would expect. So to that extent, right? So that is the reason you will see this kind of margins that is there. But as we go forward, you should be able to see that coming back to where we should be.
Vishal, does this mean that, hi, firstly, good morning. This is Harsh here, also wishing you a very happy Diwali. Does this mean, Vishal, that your full year guidance of 50% odd in terms of your top line growth, are you going to top that by a little bit more, given that this one-off has come through, or was that factored?
I would say that we have a buoyant year, and what we have promised, we should be able to deliver. Let's see how much we can do better. Let's wait for that. I would wait for a quarter before I make that statement, if I have to.
Okay. Fair point. Vishal, the unwind with regard to inventory doesn't seem visible in your balance sheet, which you've disclosed at the end of H1. Am I correct to say that there was some inventory which you've managed to sell out, but there's other inventory which is probably at a better pricing level, which has come into the inventory which you've disclosed in your balance sheet? Is that probably the right way to look at this?
Yeah, you can see that because if you look at it, there are three businesses principally there are three businesses that we have, which is agro, pharma, and polymer. So what you saw, the liquidation of inventory was more from the agro and bit of a polymer that we had, which is what we've liquidated. And because the pharma and the polymer business is growing very strongly, in more so pharma, we need to capitalize that business, and that's where the inventory has gone. And if you see my this quarter's pharma business, it's over 25% of my revenue, and to that extent, you will see that business is being fed with a working capital on an absolute basis. But if you look at from a days perspective, on a consolidated basis, we are today around about 250-260 days, which is significant improvement from where we were. So it will be a combination that you will see. One is just some inventory getting off, but we need to feed the growth as well, and to that extent, you will need some bit of a inventory to balance for that.
Any change in inventory, or rather, any change in the mix in terms of your segments? Is there anything you're spotting going ahead? Because agro is your highest performing segment, and then you have pharma after that. Any change in the mix in terms of your revenue contribution?
So see, what we have guided and suggested in past as well if you look at it, pharma agro will continue to be a very stable business for us. It will continue. There will be cycles and there will be bit of ebbs and crests that you will see, but largely you will see that is there. But pharma and polymer, they will continue to grow and they will start contributing meaningfully. So if you see pharma 2 years back, it was around about 3 to 4% of our revenue. Today it is inching towards 23 to 25% of our revenue, and we believe that it should contribute to one quarter to one third of our revenue. And so also on the polymer side, we expect that it should be hitting 15 to 20% and above, and in next 2 to 3 years time, it should also contribute around about a quarter, if not more, of our revenue. So yes, these two segments will drive additional growth and also drive the higher contribution into our revenue.
Okay, and that's on your revenue mix. If you could help us understand or throw some light on any CapEx plans you have for the rest of the year in FY27 and how they are going to be funded.
So one, if you see, we have recently completed our CapEx that we had done in the past for 670 crores, where we set up 3 plants. So, and they are now on. So we have enough capacity not to invest any significant CapEx for next near term. And this CapEx, what we have done, capacity should be sufficient for us to really support the growth. So A, we don't expect any CapEx, and B, whatever is operating cash flow which is coming in should be used to manage a healthy level of debt levels of working capital. And today, if you look at on the debt side also, practically we have repaid all our term debt. So we have largely left with only working capital debt, which will be more a resultant of the working capital movements. And we expect that the cash flow should be able to pay down a bit of debt there as well.
It makes sense because you've guided, Vishal, for 3,000 crore of turnover by FY27 or FY28. And on a 24 to 25% kind of margin, that will mean around 700 crore of EBITDA coming to you, and which should take care of some of that working capital. But talking about working capital, give us the sense as to whether there has been an intent to reduce or rather to try and squeeze on the working capital days. Talk to us about what's happening there and whether we can see improvement, and if so, how quickly.
Yeah, so if you see on the working capital side, historical, but what we have been guiding is that the ideal working capital will be 180 odd days, plus or minus 20 days is what we've been guiding in the past as well. And that's where we would want to be. If you look at the trajectory from the last year when we saw that the working capital was way beyond what we would be comfortable with, so which we have been able to correct significantly. Today, my working capital is around about 250 days of my top line on a consolidated basis, and we believe that we should be able to improve that as we go, and the journey should continue to bring it to the level that we have been guiding. So all in all, we believe that the focus continues, the priorities continues, and now we are able to see the results which we were indicating in the last 2 to 3 quarters or 4 quarters when we were guiding to that. So I think now whatever we had been suggesting, I think is now getting reflected in the numbers as well.
The sense with regard to your raw material costs, what's happening there? Could a fluctuation there cause a bit of a dent with regard to your margin aspiration, if I can call it that? Could that at all play out? What's the likelihood of that? What are you seeing on ground?
So margins, if you really see, as I had also mentioned in past as well, we have practically the pass through on terms of our costs. So to that extent, margins are not significantly impacted. My sense is that we should be in the range of 24, 25 plus or minus 1 or 2 percentage points, which we've been guiding. I think we should be hovering around that. This margins, why I'm making a allowance for a couple of 100 basis points on this is just because that revenue mix coming from a pharma, polymer and agro will have its own interplay between them in terms of their inherent margin profiles, and that would be the reflection. So I don't see too much of a cost pressure coming in here, and also as you could see that the typical raw material costs have now become very stable, and I believe that should continue. We don't see too much of volatility there. So to that extent, I think we are in good space right now.
Okay, in a good space right now, and that sounds positive. Vishal, thanks so much for your time, and we'll catch up with you in the quarters to come as well. Thanks once again.
Lovely. Thank you very much.
Thank you. So on that note, viewers, we'll slip into a very short break.